Hi, this is James Aim with Full Capital, and today I'm going to be going through top 10 questions that I received this past weekend at a multifamily conference with, probably over 500, 600 people there. Got hundreds of questions throughout the 2-day weekend, but just wanted to boil it down for you guys and talk about the top 10 questions. Just a little background on myself: born and raised in Houston, went to school in Austin at UT, did finance there, spent 10 years at G Capital, first in their F&P program, finance management program. And then the last 8 years were really on as a loan underwriter for their commercial real estate group. Then moved over to Old Capital when we were purchased by Blackstone in 2015. So I've been here about 5 years and originated close to 750 million in multifamily loans so far. And also invested in about 25 properties, currently about 21 properties as we've sold some in the last year or so. So let's jump in. So these were the top 10 questions. Really, it starts about sort of what do I do, and how can I help you in terms of financing, and then it really gets into detailed questions around net worth liquidity. How do I qualify for Fannie Mae loans? And then what can I do? What property can I buy? And then how do I really get started in multifamily? So let's just jump in here. So number one, do you lend nationwide? Do you do other property types? And how do loan terms differ? So yes, Old Capital lends nationwide. The loan amount needs to be above $1 million outside of Texas. Old Capital does other property types, but I would say we specialize in multifamily. So probably at least 75-80% of what we do is multifamily. And that makes it, that's how you become a specialist. And I think that's what makes us great. Let's go through some of the bottom portions here. I outlined how do loan terms differ? So if you look on the outside, the commercial bank loan and the non-recourse bridge loan, those lenders do all different property types. And so on the commercial bank loan, you're really 3 to 5 years, 1 year interest only, 20 to 25 year AM, and it's recourse. Whereas if you go to the non-recourse bridge, if it's over $5 million, you can get longer term debt. And then it's also 3 years interest only a lot of times. So this is what I did. This is what I did at G Capital. So we were a non-recourse bridge lender, but we did not look at anything under 5 million. And so what you'll notice, so I highlighted just Freddie and Fannie in the middle in terms of multifamily. And their big thing is sort of that $1 to $5 million space. You have a lot of multifamily properties fall into that space. And so Freddie and Fannie are doing non-recourse $1 million to $5 million deals all day. Like our average deal size probably for Old Capital is probably closer to that 5 million, but there are a lot of properties in that $1 million to $5 million that Freddie and Fannie you can get non-recourse loans for. And that is the big difference really between multifamily and almost all the other commercial property types. And then the leverage, Freddie and Fannie are going to go 80%. They're going to give you anywhere from 1 to 6 years interest only. And the amortization is going to be 30 years. And so the multifamily financing is great compared to almost every other property type. So a lot of people at this conference, they started in single family. They might have bought 1 to 10 properties using Fannie Mae. And their question was, all right, I get single family, but what's different about multi? And so I highlighted a couple things here. Difference between single family and multi. Number one, single family, all your loans are going to be recourse to you personally. Whereas Freddie and Fannie, you can get non-recourse. The loan term on single family is typically 15 to 30 year, fully amortizing. So over that 15 years or 30 years, depending on what you choose, that loan pays off completely. Whereas Freddie and Fannie, they are balloon payments at the end of their loan term. So you are not going to fully amortize these loans. It's going to be anywhere from 5, 7, 10, 12 years, typically for investors. Interest only, I have not seen interest only typically on single family. Freddie and Fannie were anywhere from 1 to 6 years. Amortization is sort of what you choose on single family. Most go 15 or 30 year. Freddie and Fannie 30 year. This is a big thing that most people don't realize on the prepayment side. So single family, There's no prepayment, right? So if you want to sell your house, your rental house, whether it's year 1 or year 10, the bank doesn't charge you additional money. But Freddie and Fannie, on Freddie SBL, which is sort of 1 to 7.5 million, they have what's called a step down prepay. And so that's going to be a percentage of the loan. Whereas Fannie Mae, it's going to be yield maintenance, which is significantly larger. And there's a specific calculation for that, but it's anywhere from 10 to 20% of the loan amount. So it can be very high. And then the last thing is valuation. So when they go to lend on these properties, single family, it's always going to be sort of your CMA, comparative market analysis, the sale comps in that neighborhood. If every house in that neighborhood sold for $150,000, then essentially yours is going to be $150,000 if it's similar square footage, right? So if everything's 100 a foot, essentially everything's going to be 100 foot, regardless of the rental income. Whereas Freddie and Fannie, they do an appraisal and lean heavily more on the income approach. So your rents minus your expenses, take that NOI, cap it at a market cap rate, and that income approach is going to determine what they can loan against that property. All right, number 3, what are requirements for non-recourse multifamily loans? And so most people are used to their standard recourse single family loans. If you move over to non-recourse multifamily loans, what are those requirements? Number 1, net worth needs to be greater than the loan amount. Number 2, post-close liquidity. So after the down payment, how much liquidity do you have? Needs to be greater than 10% of the loan amount. The people signing on the loan need a credit score greater than 650. You need prior multifamily experience on these non-recourse loans. Occupancy needs to be 90% for the last 90 days. The debt service coverage, because it's non-recourse, they are looking more at the property. So I would say probably 75% of the weight is on the property, 25% on the borrower. They're going to take the NOI divided by your debt service, which is your principal and interest payment. It needs to be 125 or higher. And then the max that they're going to do is 80% loan to value. All right, number 4. So it leads to the next question. What counts towards your net worth and liquidity? So net worth is just going to be your assets minus your liabilities, right? And you can count your equity in your personal residence and your IRAs. That's fine. Where people get this mixed up a little bit on net worth, as an accredited investor, when they ask that question, are you an accredited investor? That is your net worth excluding your personal residence. But for net worth and liquidity calculations for Fannie and Freddie, they are fine counting your equity in your personal residence. Assets outside of the U.S. So if you are maybe a U.S. citizen and you have a home in Europe or something like that, where it's a house or some parents' house or assets outside, they typically do not count for Fannie Mae and Freddie Mac, just because they can't see the bank statements. They can't look up the property really. So I have not seen them been counting that. So get with us if a large percentage, most people, majority of their assets are here in the U.S. if they're investing here. But if you have a large amount of assets outside the U.S., get with us so we can review that and maybe firm that up. And then the post-close liquidity, this is going to be marketable securities in non-retirement accounts and in cash or savings and cash in checking or savings accounts, right? So this is where they really drill down, Fannie and Freddie. They're going to get 2 months of bank statements showing that liquidity. And so make sure your sponsorship group has that. So the next question is, all right, I'm qualified. I got my net worth and liquidity, but why is my loan not 80%? You told me the max that I can get is 80%. So let's say I'm buying a $10 million property and you give me a loan term sheet at $7 million. Why is it 70% leverage versus 80% leverage? And the thing you have to remember that there are 2 constraints on your loan. One is the leverage, but then also it is the debt service coverage. And debt service coverage needs to be 125. So 125 is the minimum for Fannie Mae. Freddie Mac has some markets that are maybe top markets that they feel they can go down to 120, but 125 is a good gauge. And so how do they come up with that debt service coverage? So I gave you an example here on the left-hand side. So they look at the net rental. They take the last 3 months, annualize that net rental. Other income, they take the T12. Management fee, depending on the unit count, this was a rather large property, so I think they use 3% here. They will look at your pro forma expenses, so admin, payroll, R&M, insurance, taxes, but they will take T12 on your utilities and water and sewer. And so you have to sort of take that in, get your expenses, and they put in replacement reserves. So replacement reserves is above the line, and that is typically, let's say, 300 a door in today's market. So you're taking income minus your expenses, getting to your net cash flow. So on this example, the net cash flow was about 600,000. All right, and the debt service, principal and interest, were 479. So that lined up at 125. And so that is the max loan. There's nothing that you can do to change that loan amount. So if you paid, let's say it's qualifying for a $7 million loan, if you bring down your purchase price, then you'd be closer to 80%. But in today's market, we're seeing most deals around that 70 to 75% leverage point. I am not a US citizen. This is the next question. I am not a US citizen. Does this impact my lending options? So for Fannie Mae, you are going to require a waiver. What that means is essentially the delegated underwriters will have to submit a package to Fannie Mae to get a waiver to include you in the loan. And then also you will need an opinion letter from your country of origin. That opinion letter, depending on what country, Canada, I would say, is pretty easy. Some of the other countries might be harder, but you're going to need an opinion letter, which is going to be anywhere from $3,000 to $5,000, depending on where it comes from. And then it might take extra time getting that waiver. So just have that built in to your deal. Freddie Mac, on the small balance side, they really like to see 2 times your net worth, 2 times your liquidity if you are not a U.S. citizen. So, and so the conference I was at, they are essentially a mentorship group here in Dallas. And the question that I kept getting was, how does this group help me? Like, why can't I just do this on my own? And I would say there's really like 4 things that mentorship groups do. Number 1, access to deals, right? So if you're coming in and you're brand new, how are you going to even find deals? And how are listing brokers going to take you seriously? How are you going to raise equity? So number 1, access to deals. Mentorship groups have a track record in those markets. Number 2, access to vendors, right? So multifamily is definitely a team sport. And as you buy your first multifamily property or even invest in your first multifamily property, you're going to need, obviously lenders, you're going to need property management companies, you're going to need insurance companies, you're going to need attorneys, and finding all of that stuff becomes more and more difficult. Access to other general partners. And so we're going to talk about this a little bit later. But when you go to qualify for that multifamily loan, let's say you want to buy 100 units in Dallas right now, that's $10 million. How are you going to qualify net worth, liquidity, and experience for that loan? In these mentorship groups, there are hundreds of people with those qualifications already. And so the mentorship group really shortcuts that and gives you access to all these people. And they're already interested in multifamily. You're not having to convince them that multifamily is the right investment for them at the time. They're already there. They've already paid the money. They're already part of the group. And then access to a large number of loan partners. As you do your first deal, a lot of people can buy their own deal with their own money at beginning. But if you want to become, a syndicator and really do a large number of deals, like a deal a quarter, then you're going to need more limited partners to raise equity from, and the group has these as well. And so we spoke about this a little bit earlier, and it sort of ties into if you're qualifying for this loan. Let's say you're the general partner, and now you find a $10 million deal, get it under contract, but your net worth is $3 million. And so you are short of the requirements to qualify for the loan. And you need $7 million in net worth and $700,000 in liquidity. how are you going to reach that point? Um, and so remember, net worth needs to be equal to or greater than the loan amount of this. So the sponsorship group's net worth needs to be equal to or greater than the loan amount. And then also the sponsorship group needs 10% of the loan amount in post-close liquidity, right? And so a lot of times these general partners will ask for what's called a key principal. And this key principal is going to sign on the loan. And that person is essentially going to lend their balance sheet to this transaction. Whether or not that person gets any additional compensation is all negotiable between the general partner and the key principal. And so a lot of people say, well, why should I sign on as a key principal? Well, this is one level up from being a limited partner, right? So you're a limited partner, essentially you're putting 50 to 100,000 in the deal and you are not on the loan. Moving up one level as a key principal, this allows you to get more experience in the eyes of Fannie Mae and Freddie Mac, and you're sort of one step below the general partner in terms of experience. And so this is a good middle step for most people. It gets them experience in multifamily. But then there's a lot of competition to be a key principal on people's deals. So how do you get chosen as one of these, right? So I would say number one, be prepared with your personal financial statement. So understand your net worth and liquidity and see that as a strength. Number two, schedule real estate. Understand that the banker is going to look at your schedule of real estate, whether it's in multifamily or outside. Number three, resume. Number four, last 2 months of bank statements. So have those things ready, because when a deal comes out, a general partner is going to ask you for all these things. Number two is network with other general partners and figure out who needs net worth and liquidity. What does the general partner need help with, right? Do they need help, finding the deal, raising the equity, balance sheet? What are the things, maybe even asset management? What are the things that they need to qualify for loans and actually win the deal? Number three, grow your investor database. And so if you have a strong investor database and you can say, hey, look, I'm going to sign on this deal. I can help with the asset management. I can help with the equity raise. That is a huge differentiator. So that's the last point. Help with the asset management. If you're local, that helps as well. And then what happens is you sort of rise to the top of the stack as a key principal versus being like everybody else, right? So when the deal goes out, everyone raises their hand. I want to be a key principal. Now they got 20 people who want to be a key principal, but how do you be that one or two? Because on these deals, typically, depending on the size, you want to probably keep it to about 4 to 5 loan guarantors on a deal. Next question was, what is the largest property I can buy? Right? So a lot of people at this event, they just, whether they sold a business or have been working for a long time in an industry, they just wanted to buy a deal on their own. And their question was, what's the largest property I can buy? And so going back to the loan qualifications, number one, net worth needs to be greater than the loan amount. Number two, post-close liquidity greater than 10% of the loan amount. And so what trips people up a lot of times on this calculation is, all right, I got the net worth. Let's go through example one. Net worth of $5 million, $2 million liquid. So can I go buy a $7 million property? Well, close. You have to remember, you're going to have to put all your money down as an independent owner, right? And so let's say you put $1.5 million down and you get a $4.5 million loan. You're right on the edge. So I would say the largest property for this investor is about $6 million, right? Because you hit the net worth requirement, because only a $4.5 million loan. $4.5 million loan, you need 10% of that in liquidity. And so that ends up being, $450,000, which you have about $500,000. So you're right there on the edge. So that's probably the biggest that I would target for that investor. And I usually give people a range for the largest property, but that's probably the top end. Investor two, net worth 3 million liquid. And similar, $2.5 million, they put 500,000 down, get the $2 million loan. They still have 500,000 liquid. So they could have qualified for a bigger loan, but their net worth is the constraint on this one. So after all this, you've learned all this multifamily lending stuff. Now, how do I get started, right? So um, this is a very interesting question. So I laid out really the three ways, but then sort of what you do in those three. So I'm going to start on the right hand side, limited partner. So you don't sign as a limited partner. You don't sign on a loan. You don't manage the deal. You don't control the investment decisions. You don't find the deal. You don't get any fees. You don't. Um, you can't 1031. The two things, the one big thing that you get is the tax advantage and the distributions, and you don't do any of the work. So your time is freed up as a limited partner. So your only job as a limited partner is to find general partners, right? So find general partners to invest in, learn the business, underwrite deals that come out from the general partners, drive the deal, and decide to invest with them. That's all you're like. Once you write the check, your job as a limited partner is done on that particular deal. Your job is to essentially just find general partners to invest in. All right. Um, the second way is if you don't have, I would say if you want to move a little bit faster, you want to earn a greater return on your equity, you move into a general partner slot, right? So you sign on the loan, you are the asset manager, you control the deal. You find the deal, you control the deal. You receive acquisition fees, either or sponsorship equity. You receive all the tax advantages, and but your job exclusively is finding new deals and finding limited partners to invest with you as a general partner. And the third way really is individual. So you sign on the loan, you got control. You got to find the deal. You are making, as an individual, you are making a return on your equity alone. So you're not going to charge yourself an acquisition fee. You're not going to get a disproportionate share of profits as an individual. You're just going to make a return on the equity the cash that you actually put in the deal. You receive the tax advantages of the ownership, and you can 1031. So your job, you don't need to go out and raise equity from anybody else. Your job is just to find new deals. So really, when you look at these three paths, some people do one, two, or all three, right? So you just have to determine, based on where you are, your net worth and liquidity, your time, how much time you want to put into this business, and start choosing a path. I would say most people who have, a very large, let's say, typical individual, let's go through some typical examples. On an individual, most of the time, this person has a very strong net worth, very strong liquidity. I would say, $1 million liquidity, $5 million net worth. Going back to that other example, this person can buy a deal that actually you can get third-party property management, and it's going to not be a large percentage, I would say, of their net worth is tied up in one deal, and they're okay buying one deal a year. General partners typically do not have enough equity to invest purely as an individual or purely as a limited partner. So the general partner has to make a higher return on the equity that they have, and they substitute that with time, right? So general partner is the most time, because you have to find new deals and limited partners all at the same time, and you have to run the deal. And so general partners, we've seen examples of people making, let's say as a general partner, you take an acquisition fee, you take 15 to 20% of the deal. You might put in 100,000 in a deal. When it sells, you might get $500,000, $600,000, $700,000 compared to a limited partner who got $200,000, right? So your equity is significantly multiplied, but then you put in the time to do that deal. And then limited partner, I see people, they might have a couple $100,000 and they just want to get started. And they might do 50 to 100,000 on a couple deals and then move on to the general partner track. Where I see other limited partners where they have a business or they are highly compensated in another profession, and they just make money in that profession or business, and then invested in multifamily and spend their time on their business. And you can go either way. So those are the three ways. So next steps, subscribe to the YouTube channel here, like the video. If you want to learn more sort of about what we do, set up some time to talk with me. I usually ask, the first thing I ask is typically to fill out a personal financial statement so we can go through these different tracks and then start underwriting new deals. And as you have new deals, we can give you debt term sheets, put together your resume, sponsorship group, proof of funds, and we need to just go out there and close some deals. So thanks a lot for watching.